I'm George Ratiu, Manager of Economic Research with Realtor.com. We are in September, and while hot weather continues across many parts of the country, leaves are beginning to change in others. This week, we saw a bumper crop of indicators highlighting a resilient economy. The number of job openings saw the first increase in 4 months as companies continue to seek qualified workers. While there are still 2 open jobs for every unemployed person looking for work, companies are less motivated to fill them due to concerns over a slowing economy. At the same time, over 4 million employees left their jobs in July, a sign that the labor market remains quite strong, especially as more people who quit usually find a better job. These numbers were further supported by the August employment report. The number of new jobs rose again and the unemployment rate ticked up as more people returned to the labor force. The average hourly earnings rose from last year, but growth still lags inflation. Jobless claims further bolstered the trends, dropping to a 9-week low. It is perhaps not surprising that consumer confidence increased in August for the first time in 4 months as falling gasoline prices, solid employment, and growing wages boosted household finances. These finances were also underscored by the new FICO report, which showed that the average credit score is at an all-time high, a remarkable gain from the low of the 2008-09 housing crash. However, we are not out of the woods on recessionary concerns, mostly due to the Federal Reserve's monetary tightening. Worried about the strong labor market and rising wages, the Fed is clear that it will not relent in its push to increase the funds rate. The central bank wants to see hiring slow and unemployment rise to curb inflation, even promising that more pain is in store for consumers and businesses. With rising capital costs, consumers and businesses are likely to spend less. Higher borrowing costs are abundantly clear in slowing real estate markets. Mortgage rates jumped this week, with a typical mortgage payment a whopping 65% higher than a year ago. Realtor.com's August data highlight the impact of higher costs. With inventory growing at a quick pace and homes staying longer on the market, listing prices decelerated for the 3rd month in a row. These trends are confirmed by Realtor.com's weekly update, which points to a slowdown in new listings. Many homeowners are worried that they missed the peak and are pulling back. Against this backdrop, it's not surprising that construction spending fell in July from the prior month as homebuilders cut back on projects. This week, we also released a new research study looking at which school districts millennials prefer viewed through their home purchases. Data showed that millennials have been buying homes in affordable, highly rated school districts in metros with solid economies and tech-centric industries. Enjoy the start of September and the Labor Day celebration. We'll keep you updated on our website and Twitter feed.